So, HCL Tech just dropped its latest earnings, and the market reaction? Whoa. It was something else. On the surface, everything looked pretty decent, but the stock itself took an absolutely massive hit. So, what on earth did the market see that most of us missed? Let's break it all down. I mean, look at this, a 10% drop in one day. For a company this big, that's not just a wobble, that's the market basically screaming a message loud and clear. And yeah, that's the big puzzle here, isn't it? The headlines were all about growth, but the stock? It just tanked. So what's the real story? Let's get into it, starting with the numbers that looked so good on the surface. All right, first up, the impressive headlines. You got to see why everyone was so confused. The initial report was full of these big, splashy numbers that honestly painted a super rosy picture. Okay, the big one right off the bat, 12.3% year-over-year revenue growth. I mean, for a company this size, that is a really solid number. It makes it sound like business is absolutely booming compared to last year. And that translates to nearly 34,000 crore rupees in revenue. It's a massive number, and it seems to back up the story of a strong quarter. So far, so good, right? Everything looks great. And it didn't stop there. Net profit was also up by 4.2% compared to the same time last year. So more money coming in, more profit. That's the dream, right? But, and this is a big but, this is where the simple story ends and the real story starts. All right, now it's time to peel back the layers. Because, smart investors, they don't just glance at the headlines. They dig deeper. They look for the trends, for the momentum. And once you start digging with HCL, you find some pretty big cracks. So this is absolutely crucial to understand. The difference between year-over-year and quarter-over-quarter. Think of it like this. Year-over-year tells you how you're doing compared to last spring. It's the long game. But quarter-over-quarter, that tells you how you're doing compared to last winter. It's your immediate health, your momentum right now. And for HCL, that momentum was going completely the wrong way. And boom, here's the first bombshell. While yeah, revenue was up compared to a year ago, it actually went down compared to the last quarter, by almost 3% in dollar terms. That's what they call sequential degrowth, and it is a massive red flag. It means things are slowing down right now. And this chart, wow, this really shows you what's going on. New deal wins, that's the fuel for future growth, right? Well, look at it. It just fell off a cliff. From $3 billion in Q3 down to less than $2 billion in Q4. That tells you the pipeline is drying up, and that's a huge worry. And just when you thought it couldn't get worse, the other shoe drops. You zoom out, look at the entire year, and despite all that revenue growth we saw earlier, the company was actually less profitable. Net profit fell by over 4%. That means their costs are going up faster than their sales, and it's eating away at their bottom line. Okay, so the recent past looks shaky, but you know what the market cares about even more? The future. And this, my friends, is where the story went from just being concerning to being a total disaster. The company's own forecast was the final nail in the coffin. Now, before I show you the number, let's just be super clear on what revenue guidance is. It's basically the company's management team telling investors, hey, here's what we think we can realistically earn next year. It sets the bar, it sets expectations. And in the stock market, expectations are literally everything. And there it is, 1.24%. Just let that sink in. After posting double-digit growth, the company is now saying their growth next year might not even keep up with inflation. That huge range, 1 to 4, also kind of tells you that they don't have a great handle on what's coming either. And this table just lays it all out, plain as day. Look at this. The market was hoping for something like 3 to 6%. Last year, they did over 11%. So when HCL comes out with a forecast of 1 to 4%, that's not just a miss. That's a complete reset of what this company's future looks like. So what happens when you have slowing momentum, falling profits, and a terrible forecast? Well, you get a stock that investors are running away from, and you can see it clear as day in the technicals. So after that 10% plunge, the stock is now scraping the bottom near its lowest point in a whole year. And for traders, this is a big deal. It's trading way below its 50-day and 200-day moving averages. In simple terms, that means there's a strong downward trend. There's basically no floor holding the price up right now. It's in free fall. Okay, so We've seen the good headlines, the ugly truth underneath, and the disappointing forecast. We get why the stock collapsed. But the big question for anyone watching now is, what do you do? Is this a huge bargain, a buying opportunity, or is it a trap? Look, the case against buying right now is pretty overwhelming. You've got that weak 1 to 4% guidance. Profits for the full year actually went down. The pipeline of new deals is shrinking fast. They've got ongoing issues with some big clients. And technically, the chart looks awful. It's not a pretty picture. But it's not all doom and gloom. For people who already own the stock, there is a case for just holding on. First, after the drop, the valuation is way more attractive. You're also getting paid a really nice 4% dividend to wait for things to get better. And there are some bright spots, like their AI business, which is actually growing. On top of all that, the company itself is rock solid financially, with almost no debt. So what's the final verdict here? Well, even though the stock looks cheap after getting hammered like this, the source material leaves us with a really powerful piece of advice. And it's this: catching a falling knife is speculation, not investing. Trying to buy a stock that's plummeting this hard, especially when the company itself is signaling weakness, isn't a calculated move. It's a gamble. The smarter play might just be to stay on the sidelines, wait for the dust to settle, and see if the company can deliver at least one stable quarter before you even think about jumping in. And really, the big takeaway here is simple. Never trust the headline, because sometimes it's hiding a much uglier truth.